my pleasure to introduce Dr. Gus Faucher, this morning's moderator. Gus is the Chief Economist and Senior Vice President with PNC Financial Services. Prior to that, he was a Senior Economist with Moody Analytics. He also worked at the U.S. Treasury Department, and he's been reported on multiple media outlets, including the Wall Street Journal, ABC, CBS, NBC, CNN, and Fox Business. He's participated in the NAIOP BOMA Economic Report for approximately the last 8 years. And last year, he successfully predicted the COVID epidemic, the 2020 political changes, and all the changes in every aspect of the economy. So I can't wait to hear what he has to tell us this morning. Without any further ado, Gus Faucher.
And just for all of those who, Jamie, of course, was kidding when he said all of that stuff. Needless to say, things that have turned out very different from what how we thought things would go. But thank you very much. It's a pleasure to be here once again. This is the first event that I did when I started at PNC in the winter of the new year 2012. So it's very nice to be here once again. And let me get my screen going, and there we go. We experienced a pretty severe economic contraction in early 2020, and this was very different from the other types of recessions that we've seen in the United States. If we think about the Great Recession, which started in late 2007, if we think about the bursting the tech bubble in 2000, if we think about the double dip recessions that we had in the early 1980s, those were caused by problems in the economy. The Great Recession was caused by problems in the housing market and the financial system. The bursting the tech bubble, obviously the stock market. This recession was caused by something outside of the pandemic. And if you remember to when I was speaking to you a year ago, I said the economic fundamentals were good and that we expected the economy to continue to expand through 2020. Obviously, things turned out very differently because of the pandemic. But the good news is that an economic recovery is underway in the United States. We're experiencing a little bit of a soft patch in early 2021, but I am hopeful that as vaccine rollout continues, as we get economic stimulus, that we will continue to see solid economic growth in the rest of 2021 and then in 2022. We've seen a very aggressive response from the Federal Reserve. They've cut both short-term interest rates. You can see that's the interest rate on a 3-month Treasury bill. That's the blue line, close to zero right now, but also longer-term interest rates. We've seen a little bit of a pickup in the interest rate on a 10-year Treasury bond over the past few weeks, a little bit above 1%, but that's still very, very low on a historical basis and still well below the almost 2% rate that we had at this time last year. The Federal Reserve has pushed down long-term interest rates in an effort to support economic growth, to support business borrowing. The interest rate on a 30-year fixed mortgage rate is now below 3%, and that's leading to a very strong housing market. And the Fed's goal is that by keeping both short-term and long-term interest rates low, that will encourage consumers, businesses, governments to borrow and allow for stronger economic growth. And the stock market is anticipating a full recovery. So the blue bars, that's the S&P 500, broad measure of stock prices. You can see that it fell by about a third in early 2020 as the pandemic started to hit the U.S. economy, but it's come back strongly and has continued to grow in December of last year and January of this year as we get the incoming Biden administration and the potential for more fiscal stimulus with a democratically controlled Senate. Stock markets are forward-looking. They're looking at what's going to happen to corporate profits 6, 9, 12 months from now. So even as we do hit this soft patch in the U.S. economy in early 2021, we do see stock markets anticipating continued economic growth and continued growth in corporate profits. That being said, there's still a lot of volatility in the stock market. If you look at the orange line on the right-hand scale, that's what we call the VIX index. That's a measure of how much stock prices are moving up and down. You can see that enormous spike that we had in volatility in early 2020 as the pandemic started to take hold. Volatility has declined since then, but it's still well above where it's been for most of the past 4 or 5 years. And so I think that is indicative of the concerns that we still face going forward. Obviously, we're still dealing with the pandemic. We're not sure how the political situation will play out, whether we'll get additional stimulus, that type of thing. So I would expect that investors should be prepared for continued high volatility in 2021, even if the stock market is doing pretty well. The pandemic has put about 1/2 of the US economy at risk. So this is US GDP for 2019, and I've divided it up into various components. And there's about 1/2 that is less exposed to the pandemic. So if you look at government, about 17% of GDP, if anything, we've seen government spending increase with the pandemic. So that's not a concern. Consumer spending on non-durable goods, the orange slice, that's about 14% of the economy. That's spending on goods intended to last for 3 years, food, clothing. You still have to make those types of purchases. Consumer spending on healthcare, housing, and utilities, that's about 1/5 of the economy. The green piece, obviously, you still need to see the physician or the dentist. You still need to pay your mortgage or pay your rent. You still need to pay your utilities. But there's a lot of other parts of the economy that are more vulnerable to the pandemic. So spending on all other consumer services, that's about 24% of the US economy. That's things like entertainment, travel, financial services, what we call personal care services, which is everything from childcare to dry cleaners. And we've seen consumers cut back a lot on that type of spending, particularly on discretionary entertainment, leisure spending. Consumer spending on durables, the yellow slice, that's about 7% of the economy. Autos, goods intended to last for more than 3 years, appliances. You can always put off purchasing a new car if you feel that the circumstances don't warrant it. So that is vulnerable. Private investment, the red piece. So that includes commercial construction. It also includes investment in housing. It includes business investment in equipment, and then business investment in things like software and research and development. That's about 18% of the US economy. If businesses are concerned about the outlook, if they're not sure what's going to happen to demand, then they may put off on much of their investment. We saw a big decline in housing activity at the worst of the pandemic as we saw housing starts decline. And so that is vulnerable to the pandemic. And then finally, the black portion, exports, that's 12% of the US economy. Obviously, this is a global pandemic, and we saw a big decline in exports. And so about 1/2 of the US economy is vulnerable to what's going on with the pandemic. And with that, we saw an enormous contraction in economic activity in the first half of 2020. A real GDP, which is output of goods and services, that's the broadest measure of the US economy that we have. It's adjusted for inflation. That fell by about 10% from the fourth quarter of 2019 to the second quarter of 2020. Basically, the US economy was producing about 10% fewer goods and services in the second quarter of 2020 than we were in the fourth quarter of 2019. To put that in context, during the Great Recession about a dozen years ago, real GDP declined by about 4% over a period of 6 quarters. So this was a much steeper decline in economic activity in a much shorter period of time. And we saw similar declines in other measures of economic activity like gross domestic income, which measures the income going to households and businesses, and what we call final sales of domestic product, which is GDP minus the change in inventories. That measures demand for goods and services produced in the United States. Now, we did have a good rebound in the third quarter of 2020. The US economy made up about 2/3 of that initial decline, but GDP is still about 3.5% smaller than what it was before the pandemic. And that is still a significant contraction. We still have a lot of lost ground to make up. We have seen improvement in a lot of economic measures from the worst of the pandemic. So the blue bars here show the change between February before the pandemic and then April when we were at the worst in terms of government shutdowns and that type of thing. And then the orange bars are the change between February and December, except where we have less recent data. So for example, food service, that's restaurant sales, those declined by more than half between February and April. They're now down by about 20% from where they were in February. And in fact, they've worsened a bit over the past couple of months as the pandemic has re-intensified and we've seen more restrictions. But still, we've made up a lot of that lost ground. Unit auto sales, those fell by almost 1/2 between February and April as auto dealers closed down and as car buyers stayed home. They're basically now back to where they were before the pandemic. Housing starts, those fell by about 40%, but with low mortgage rates, with strong demand for housing, those have come back to where they were at the pandemic. Existing home sales, those fell by about 1/4. They're now up about 15% from where they were in February. Again, 30-year fixed mortgage rate below 3%, people looking to perhaps move out of apartments and into single-family homes, very strong housing demand. Industrial production, output of manufacturers, mines, utilities fell by about 16% initially, now down by about 4% from where we were in the pandemic. Food and beverages, those are in grocery stores. That rose by about 10% initially. People are still eating at home more, eating out less, so still well above their pre-pandemic level. And then finally, nominal after-tax household income. So this is the income that goes to households, not adjusted for inflation. You can see that that actually jumped by about 12 or 13% between February and April. We had those stimulus checks. We had extra unemployment insurance benefits. So we actually saw household income go up even at a time when the economy had lost 22 million jobs because of all this government stimulus efforts. And it's that increase in household income that has allowed consumer spending to rebound and has allowed for the rebound that we've seen in the US economy since the worst of the restrictions, since the worst of the shutdowns in March and April. Now, as that stimulus funding has faded, we have seen household income in November, it was just a few percent above where it was before the pandemic. Now households are getting stimulus checks again. Those are being distributed now as we speak. So I would expect that it'll be up a little bit in January from where it was in November. But it's really those stimulus efforts that have allowed for this rebound that we've seen in the US economy. And we've also seen a rebound in the labor market. So in March and then especially in April, we had enormous unprecedented job losses. We lost about 22 million jobs over 2 months. To put that in context, during the Great Recession, we lost about 8 million jobs over 2 years. So this was a much greater loss of jobs over a much shorter period of time. And so you can see that now we did have small job losses in December of 2020, we lost about 140,000 jobs. It was a weird jobs report. We lost about 500,000 jobs in what we call leisure hospitality services, mostly restaurants, but also hotels, live entertainment, casinos, that type of thing. But other industries actually added jobs in December as they continued to see recovery. So, obviously not good that we had those job losses in December, but other parts of the economy looked good. We are hitting a rough patch as we've seen cases of the coronavirus re-intensify, record high caseloads in many parts of the country. We've seen a return to some restrictions on economic activity. Outside of a few industries, the economy actually looks fairly solid in late 2020, early 2021. And again, I think those stimulus checks will help support government spending. And I think this chart shows very clearly what's been going on in the labor market. This is the employment to population ratio. This is the share of adults 16 and over who are working. You can see that before the pandemic, that was at about 61%. Then it fell to about 51% in April. It's come back. It's still at about 57% in November and December, which is certainly better than where we were last spring, but it indicates that we still have a long ways to go. This is basically only back to where it was in the 1970s. And if you think about all the big changes that we've had in the labor market over the past 40 years or so, the entrance of baby boomers into the labor market in much larger numbers, the entrance of women into the labor market in much larger numbers. And we've wiped out a huge amount of that progress with the pandemic. Now, I am hopeful that we will see strong job growth in 2021, not earlier in the year, but as the year progresses and the vaccine distribution continues, but we still have a lot of lost ground to make up in the labor market. One big positive for the recovery that we're seeing right now is that consumer balance sheets are actually in pretty good shape. So if you look at the personal savings rate, that's the blue line on the left-hand scale, you can see that even before the pandemic, that was well above where it was heading into the Great Recession. So consumers had more of a cushion. And then you can see that enormous spike in the personal savings rate in the early part of 2020. Basically, households got those stimulus checks, so they had more income. At the same time, they didn't have anything that they could spend their money on. They weren't going out. They weren't going on vacation. They weren't eating out at restaurants. So we saw a big jump up in the personal savings rate up to about 26%. It's since fallen, but still very elevated. And so that means that consumers do have a big cushion that they will gradually spend over the next couple of years as the vaccine is distributed, as people feel more comfortable going out. Similarly, if you look at the financial obligations ratio, that's the orange line on the right-hand scale. That's the share of income that goes to regular financial payments. So it's rent for renters, mortgage payments, credit card payments, student loan payments, auto loans and leases, property taxes, homeowners insurance, that kind of thing. That is very, very low right now, basically the lowest we've had in the history of this series, and this goes back to 1980. So consumer balance sheets are in pretty good shape, and that means that, again, consumers do have a cushion, and so that as economic activity improves with low interest rates, consumers, for example, have a little bit of room to borrow and finance purchases of homes or new cars, that type of thing, and that will support economic recovery in 2021, 2022. Business debt is a little bit more of a concern. If you look at the blue line on the left-hand scale, that is debt of non-financial corporations as a share of the size of the economy. That was already at a record high heading into the pandemic. And then it increased further as businesses drew on their lines of credit to make sure they had enough cash to get through the pandemic and took out loans through the Paycheck Protection Program. But the good news is that with very low interest rates, businesses don't have much difficulty financing that debt. Interest payments as a share of cash flow for non-financial corporations, that's very, very low right now, the orange line on the right-hand scale. So businesses have taken advantage of very low interest rates to refinance their debt. So although their absolute debt levels are high, the cost of paying off that debt is very low right now. And so I'm not terribly concerned about business debt at this point. Obviously, if rates move higher, that becomes more of a concern. But I think that businesses right now are able to meet their financial obligations and pay off their debt gradually. And so I'm not terribly concerned that that is going to weigh on business investment in 2021. We've gotten a huge amount of stimulus from the federal government. This does not include the stimulus that was passed at the end of December. I need to add that in, but you can see that we had about $750 billion in loans and grants to small businesses. That's primarily the Paycheck Protection Program. That provided very low interest loans to small and medium-sized businesses, and those loans will turn into grants. Basically, they're given money from the government if they meet certain criteria in terms of maintaining staffing levels and maintaining pay. I'm on the board of a small nonprofit here in Pittsburgh, and we're going through that application process right now to have that loan turned into a grant, and that's been exceedingly helpful. We had those one-time stimulus checks in the spring of 2020, about $300 billion that really supported consumer income. And as I mentioned, we're now getting additional checks that are being paid out early in 2021. And so that's been enormously helpful. We had extended unemployment insurance benefits. We had bonus unemployment insurance benefits. So all of these efforts have really made a huge difference and have allowed for the rebound in the U.S. economy that started in the late spring, early summer of 2020, has continued. Obviously, as I mentioned, activity is a little bit weaker now, but will support recovery in 2021. And I'm hopeful that with the Biden administration, we'll get even further additional stimulus this year. And this stimulus has made a huge difference. So PNC does a small business survey twice a year. This is from our fall 2020 results. And you can see that among those small and medium-sized businesses that applied for Paycheck Protection Program loans, 97% of them said it was important to their business, including 69% that said it was very important. And businesses did feel that they needed more aid. Now, again, this is from the fall before we got that additional stimulus, but about 2/3 of the small and medium-sized businesses that we interviewed said that additional stimulus was important. And so that stimulus that we did get at the end of December really will help the recovery that's in place right now. We shouldn't be worried about the national debt right now. Interest borrowing costs for the federal government are extremely low. The federal government can borrow for 10 years at around 1%. It makes much more sense to invest now so that we have a strong economic recovery and a strong economy, and then we can deal with those issues over the longer run. And then, as I mentioned, we've also seen an enormous response from the Federal Reserve. So the Federal Reserve, in the early stages of the pandemic, cut short-term interest rates, pushed the Fed funds rate, which is their key short-term policy rate, basically down to zero. They said that isn't enough. We need to do more to support the economy. So the Fed has been buying longer-term treasuries. They've been buying mortgage-backed securities. That pushes down long-term interest rates as well. That's what's pushed that 10-year treasury rate down to about 1%. That's what's helped push 30-year fixed mortgage rates below 3% in an effort to encourage more borrowing by businesses, by consumers, by potential home buyers, by governments to support growth. And so that's been a key driver of what we're seeing in the economy right now. In particular, that recovery that we are seeing in the housing market that is taking place and that is adding to economic growth. And I don't think we should be terribly worried about inflation, even with all of the stimulus efforts from the federal government and the Federal Reserve. Inflation has been too low for most of the past decade. The Federal Reserve would like to see inflation average about 2%. Inflation has been below 2% for most of the past decade with the weak recovery that we saw from the Great Recession. And so the Fed would like to see stronger inflation. This chart shows what financial markets expect inflation to average 5 to 10 years from now. So roughly from 2026 through 2021, you can see that it's just barely above 2%. The Fed would like inflation to average around 2% over the long run. And so, inflation is very low right now. So the Fed wants to see a bit stronger inflation. I think we will get a bit higher inflation, but I'm not terribly concerned that inflation is going to get out of control really anytime over the next decade or so. So there's a great deal of uncertainty out there about what's going to happen. So here's what I'm pretty sure about. First, that we did experience a very steep recession in the United States in the first half of 2020, but that a recovery has started. Now, with the recovery, I don't mean that the economy is good. What I mean is that the economy is better than it was back in the spring. We still have a long ways to go, but we are making improvement. The unemployment rate peaked. Actually, that should be 14.8%. They revised the numbers. At 14.8% in April, that's the highest unemployment rate that we've seen since the Great Depression, but it's since fallen and is down to 6.7% at the end of 2020. Still well above the 3.5% unemployment rate that we had at the beginning of 2020, however. So still a lot of unemployment out there in the economy. Inflation will remain low. And then we're also seeing structural shifts in the economy. So we're seeing consumer spending, which was already moving away from traditional brick and mortar retailers towards online sales. That process has accelerated. Obviously, we're seeing more, Amazon online sales, more distribution, warehousing, transportation, that types of thing. We're also going to, I do expect that retail real estate will remain under pressure, for the foreseeable future. And then we may see shifts in office real estate as well. Obviously, most of us are working from home. We're not expected at PNC to be back in the office until at least March. So who knows what's going to happen to the demand for office space going forward. But I do expect that there will be big structural shifts in commercial real estate markets. What I'm less sure about is how strong the recovery will be this year. Will we have a V-shaped recovery? Will we have a more gradual U-shaped or an even more gradual Nike swoosh shape? It's possible that we have another contraction in economic activity in early 2021 because of the pandemic, because of business closures. How effective the Paycheck Protection Program is as preventing business failures. The more business failures we have, the longer it takes the US economy to recover. Will we get additional stimulus? I think the outlook has changed with Democratic control of the Senate. I would like to see more stimulus, but we'll have to see how that goes. How quickly the unemployment rate declines, whether the pandemic has a long-run impact, results in slower long-run economic growth. And then finally, we are seeing shifts in the housing market. We don't know how permanent these are going to be. Are we going to see people over the long run move away from living in cities towards the suburbs, away from apartments towards single family homes? We'll have to see how that plays out. What matters? The public health response. If we don't get this right, then nothing else matters. Obviously, the vaccine distribution will be very, very important. If we botch that, then we are going to see a very, very weak economic recovery. How much more stimulus? I would like to see more stimulus rather than less stimulus. I think I would much rather err on the side of too much than too little. In particular, we need additional aid for consumers. We need additional aid for small and medium-sized businesses. We need aid for state and local governments because they're going to face funding pressures with a lot of their revenue streams drying up. And then finally, we obviously need aid to make sure that the public health response is robust. And then finally, business assistance. How many business failures are we going to see? If we can help small and medium-sized businesses get through the worst of this and then reopen on the other side without having to close permanently, that will allow for a stronger economic rebound. And in fact, according to our survey of small and medium-sized businesses, about 1/3 said that they could only survive a year or less under current economic conditions. So there is the great potential for a lot of business failures that would really scar the economy and slow long-run economic growth if we don't do enough to support the recovery. So here's our forecast. You can see that we had this enormous contraction in real GDP in the first half of 2020. We are in the early stages of recovery. I think that we'll see slow growth in the first quarter of this year, but then I expect to see much stronger growth in the second, third, and fourth quarters of 2021, and then growth slowing somewhat in 2022, but still above the economy's long-run average as we put people back to work as businesses reopen. The unemployment rate, which I mentioned, peaked at 14.8% in April, down to about 6.7% at the end of 2020. End this year at around 6% or so, and next year at around 5% or so. That's good news, but certainly that's still above that 3.5% unemployment rate that we had at the beginning of 2020. And then this shows various measures of economic activity and how long it's going to take to recover. So real GDP, for example, we don't expect that to return to its pre-recession peak until later this year. Other economic indicators, it's going to take longer to return to their pre-recession peak. Industrial production, output of manufacturers, mines, and utilities, employments, we may not have a full recovery there for a few years. That being said, housing starts very strong. They'll be above their pre-recession peak this year because of those record low mortgage rates. So we are going to see varying speeds of recovery in different parts of the economy. And for a lot of these measures, it's going to take a lot of time to make up that lost ground. Let's take a quick look at the regional outlook. This is the Philadelphia Fed's State Coincident Index from February of 2020. And you can see that most states were in that green expansion category. So we had solid growth throughout the country. You go forward to May, and every state was in significant contraction in that very dark red category. The pandemic hit states throughout the nation, and we saw a huge contraction throughout the country. And that's really that's very different from typical recessions, where usually at least some states will be growing. But you go forward, this is the latest map. This is from November, and most states now are expanding. We can see in particular that manufacturing related states are doing particularly well, as we've seen a rebound in the auto industry and demand for goods, but generally solid economic growth throughout the United States. Still have a long ways to go, but a significant improvement from where we were earlier in the year. In terms of Pittsburgh, job losses in the Pittsburgh metropolitan area, so that's Allegheny, Armstrong, Beaver, Butler, Fayette, Washington, Westmoreland counties. They were larger than what we saw in the rest of the United States, in part because the Wolf administration imposed more restrictions here than what we saw in many other parts of the country. But we have seen a pretty solid rebound in jobs in the Pittsburgh metro area. We're still down by about 7 or 8% from where we were before the pandemic, but we've made up about 1/2 of the job losses here in the Pittsburgh metropolitan area. The good news is that Pittsburgh is less exposed to some of those industries that may face the greatest restructuring difficulties. So oil and gas manufacturing, air transportation, leisure, hospitality services. Pittsburgh has a greater concentration in industries that are less exposed to the pandemic, like education, healthcare, that type of thing. So the long-term restructuring for Pittsburgh will be less than what we see nationally. We interviewed small and medium-sized businesses in Pennsylvania for our survey, and we did find that generally businesses in Pennsylvania were a little more pessimistic about the outlook than businesses in the rest of the country. Now, some of that was weaker growth in Pennsylvania heading into the pandemic, but I think it is fair to say that small and medium-sized businesses are more pessimistic here than they are in the rest of the country. And then finally, I show this every year. For the long run, this is what matters. And again, Pittsburgh has had declining population in the entire metropolitan area for most of the past couple of decades. That does make it tough to attract businesses, and so we need that skilled young workforce to figure out how to attract the types of employers that will create economic growth and well-paying jobs over the longer run. You can find all of our materials at pnc.com/economic reports, and you can follow me on Twitter at Gus Faucher PNC. So thank you very much. And for now, we are going to go into our panel discussion. And so I would like to welcome our guest, Riza Kumasawa, who is an associate professor of economics, and she is chair of the Department of Economics and Finance at the Donahue Palumbo School of Business at Duquesne University. And then we have Kyle Chintalapalli from the Allegheny Council on Community Development and the Pittsburgh Regional Authority. And Kyle has been there for a couple of years, and previously for 7 years, he worked for the Pittsburgh City government, most recently as Chief Strategy Officer for the Urban Redevelopment Authority of Pittsburgh. So let me start with Kyle. So Kyle, what are you seeing in the Pittsburgh regional economy? What industries have held up better? What industries have done worse? And what concerns do you have as we come out of the pandemic and as economic activity picks up in 2021?
Yeah, that's great. Thanks, Gus. I want to thank NAIOP and BOMA, Amanda and Brandon for inviting us here today to speak to everybody. I did a quick glance through the participants and saw a lot of familiar names, so it's great to be with everyone this morning. Yeah, I mean, to your question, I think a lot of what we saw through the course of last year, I think closely mimics what you showed on your slides, just in terms of our project pipeline sort of that was still healthy, and I'll speak about it going into 21 as well. It remains healthy, but we did see a lot of businesses begin to delay responses. Obviously, some, still made decisions to come here, initially with a remote presence, maybe Zoom most notably, right? When they made the decision to open one of their R&D centers here, they're taking their time on ultimately determining a physical location, which I know for this group in particular is of interest, but have been committed to having a presence here in Pittsburgh. And, there were a number of projects similar to that. I think, what you also mentioned at the end in terms of the complexion, makeup of the local economy, the sectors where we have strength, the sectors where we've grown and continue to see interest, right, are some that are a little more durable to at least the non-economic reasons for why, the recession and the economic situation we're in. And by that, obviously in robotics, you still need a physical space, right? You still need to be located somewhere. In life sciences, the same sort of way. So going into 21, our project pipeline does remain healthy. We actually just did an internal report on it last week to take a look at where things stood, and we're pleasantly surprised by the number of projects that are in there. They do split up across those sectors when we talk about life sciences and health, tech in robotics, AI, fintech, cyber, the energy space, and then also manufacturing, logistics, distribution. So, those decisions, much as you said, in terms of when the expectation of the recovery to really hit, a decent stride, let's say Q2, Q3 this year, we expect those decisions to happen, later this year. But, we're still having those conversations. We're doing virtual visits where we can, socially distanced ones where we, where possible as folks, become more comfortable with travel. So I think we remain optimistic for later this year and are doing efforts to step up outreach, et cetera, in the interim.
Great, thank you. And I just want to remind people, and I'm sorry, I should have mentioned this earlier, but if you do have questions for myself, for Kyle, for Risa, please enter those in the Q&A function, and we will try to get it to as many of those as we can. So Risa, your background is as a labor economist. So what have you seen during the recession that we experienced, during the recovery that we've experienced in the labor market, and what concerns do you have for the labor market over the long run because of the disruptions we've seen from the pandemic?
So this recession was quite different from previous ones, as you said, because of the nature of how the recession occurred. So this was all health driven because of the pandemic. And so the industries that were hit the hardest were those where remote work was not possible. So leisure, hospitality was hit the hardest. Now, what I saw as a labor economist that troubled me was the amount of economic inequality that has resulted because of the differential impact on different groups of people. And unfortunately, the individuals that were hit the hardest tended to be women, and especially women of color were impacted. And so I think everybody finally got to see the inequalities that always had actually existed. So in 2019, already half of all working women were in low wage jobs, making about $11 an hour. So this is pre-pandemic. And then about 15% of working women were single parents. And then 41% were living in households that were below 200% of the poverty line. And then 25% were also receiving safety net benefits such as SNAP. And so when all of this, these terrible things happened with the pandemic, we saw these groups being especially hit the hardest. And so now I worry about the recovery. If we treat these groups in the same manner, everybody gets the same paychecks, then we're not going to get to the root of some of the inequalities that have always existed. And so I worry about that part of the recovery. How are we going to deal with the inequalities now that's out in the open? So you talked about on average what things are going to look like, but I do wonder how this is going to impact the different income groups, racial groups, gender groups, et cetera.
Yeah, and it's interesting because we actually saw a decline, for example, in poverty at the early stages of the pandemic because of those stimulus checks, which were distributed very broadly throughout the economy. And so that was, it's been very interesting. Kyle, any thoughts on that in terms of what the implications of that for the Pittsburgh area economy?
I think, yeah, in terms of, if you look at the jobs report, as it relates specifically to the region, right, it does mimic that, right? Like there's been slow, there's still significant losses in those sectors that Risa cited. And I'm glad you kind of leaned right into it, Risa, because I was actually through the conversation going to sort of ask, I guess, to both, you're both economists. I just know enough to be dangerous, and I'm a little intimidated by, having the conversations that we're set to have, with both of you this morning. But, Gus, and the shapes that you cited, right? Like the K shape that I think Risa is speaking to, wasn't one of the ones that was sort of brought up there. So I'm interested to see, as the conversations around what additional fiscal stimulus, might look like. I mean, you mentioned, certainly state, local governments. I think, while they've been stable thus far and have done what they can to, allocate the resources that they've had as appropriately to kind of keep the ships afloat. Obviously, and most notably with the city even saying, like, our budget's basically in place, right, till June. After that, if there isn't additional assistance, they're going to have to make tough choices. And I don't think, the city of Pittsburgh is unique in that locally, and certainly not nationally. So what that means, the ripple effects of that, to say nothing of the need for, additional stimulus as it relates to a particular demographic kind of groups or workers that have been disproportionately impacted from, the recession that we're in the midst of. But I think Risa stated it well, more broadly, it really sort of laid bare the inequalities that maybe weren't as front of mind for folks, beforehand. So, I think those sectors where we've seen growth, and we're projected to grow prior to the pandemic, are going to continue to do so. Those were the ones, that I would say were cited, obviously in our project pipeline and the projects that we're most directly involved in. We aren't as involved in those related to, restaurants, right? Mm-hmm. Or the service industry, and certainly not sort of leisure, entertainment as directly. Those are obviously tenants of a lot of the people that are on the webinar this morning. And I think importantly, do a lot to, really define the culture of a place. Restaurants, when we think about, the touchstones, right, of where that defines. And I think it was really discussed kind of eloquently a couple of weeks ago, or a few weeks ago, when they did the downtown event with the Business Times, and they really spoke to the importance there. So I'm interested to see and to hear from both of you, sort of as it relates to that additional fiscal discussion, what that might look like, and how that can be sort of used to address the issues that Risa I think outlined very well.
And Risa, I think one of the things, and Kyle mentioned the pressures on government, and this is a very different recession because we haven't seen the decline in housing values that really hit property tax revenues the last time around. But isn't it the case that women and people of color tend to be overrepresented in government employment, so there's some vulnerability there as well?
That's correct.
Okay.
Yeah, and the industries that you normally would think would be safe from the impacts of recession, in this recession certainly are not. So government jobs have always been relatively stable during recessions, and then the education sector as well. So I can talk about higher education, where for the first time I've actually seen tenured faculty being laid off from universities, and that's something that was that really concerned us, because we were considered one of the safer industries.
Right.
And then with respect to, you talked about the demographics, the age, and declining younger population in Pittsburgh. That's actually going to impact education for us, especially at the college level, because we were going to experience something called the enrollment cliff starting from about 2025, where, because of the last recession, declining fertility rates, that universities were going to have hardships trying to enroll students of college age. Now, the pandemic hit, and then this problem has now sort of accelerated for us. And so, now you see universities trying to be very forward looking in terms of coming up with new programs. It kind of forced us to be more innovative in terms of how we deal with the future enrollment cliff that's about to happen.
Mm-hmm. Okay, I want to get to some of the questions that we're getting in from the audience. So first one is for Kyle. Is there a specific strategy to recruit companies that may want to relocate from major urban areas with their pandemic challenges to the smaller Pittsburgh market?
Yeah, I see that from Bill Hunt. So hi, Bill. I mean, the short answer is yes. We've begun to do significant outreach to companies, in larger markets, ones that we've researched that also are positioned and poised from either receiving a large, recent investment over the last year for growth, or have, sent signals otherwise that they're looking to relocate. I do think it's something, that we're able to illustrate to them when you talk about, our proximity to other major markets, the ease of connectivity, to say nothing of, the state of kind of remote work and what that means. And I think how that's having businesses rethink the way they approach. Yeah.
Mm-hmm. So the next one is about the future of the oil and gas industry in 2021. I'll start with that one. We are in a world of structurally lower energy prices now. If you look at a lot of the what we've seen with the airline industry, with reduced peak commuting, that type of thing, there's just less demand for oil and gas nationally, internationally than there was before the pandemic. And so that's really pushed down energy prices. It's reduced energy development in Western Pennsylvania. And I think that energy prices are going to remain structurally lower. Now, we did see an increase in energy prices recently. OPEC has changed some of their production, and they've I think Saudi Arabia has cut back on production. But the U.S. with the big boom that we've seen in fracking, particularly over the past decade and a half or so, has a much greater role in international markets. And as we see prices rise internationally, we start to see U.S. production pick up and push down prices again. So I think that, I do not expect energy prices to move much higher in 2021. I think maybe by the time we get to 2022 or 2023, we see a little bit higher prices. But that being said, we've developed new technologies that allow better access to oil and natural gas. We continue to move away from fossil fuels in many respects with the development of wind and so forth. And so I think that structurally, energy prices in the future are going to be lower than they've been in the past. And I really do not expect to see a strong rebound in the energy industry anytime soon. I don't know, Kyle, if you have any thoughts on that.
I think until demand kind of returns to where it was, right, it's hard to sort of project. So I think much like the other portions of the economy that we've talked about, until we're all able to sort of move about freely and openly, it's hard to sort of know, at least for 21, that it'll be significantly or substantially different than what it's been currently. But
next question. What about the nonprofit community in 2021 and what's going to happen there? Reza or Kyle, any thoughts there?
I'll look at Reza.
Which one? I mean, there's quite a diverse group of institutions. I suppose a lot of these would depend on how we deal with the pandemic first, whether you're looking at universities, hospitals. I'm not really.
Okay.
It's a diverse group, so it depends.
I mean, what I'll say is, you go back to that slide that shows the share of the economy, and I do think that nonprofits generally, first of all, that nonprofits who do income assistance, that type of thing, I mean, obviously they're going to have greater demand for their services. But at the same time, I think that many households have taken a hit in terms of income, so the contributions may be down or people are concerned about their future. And then also, I think it's fair to say that those that provide services in person, I mean, that's just a lot more difficult to do in the current environment. And so a lot of that depends on the path of the pandemic.
Yeah, I guess I would say to when we think about, the leisure hospitality, right, there's significant nonprofits here that are in the performing arts spaces as well. And I know for that sector specifically, as it relates to both stimulus funds that are kind of in place currently that need to be deployed, and then others that are coming through, through the chamber and others, we've been hopeful to advocate for, specific kind of, let's say, set aside or carve out to help, support groups like that. So
okay, and I got a clarification that it was community nonprofits. I think we covered that, so I think we're good there. So, all right, a couple questions about the stock investing in the stock market and so forth, and I'll take a stab at those. Just to make it clear, I'm an economist, not an investment advisor, so please don't come to me for investment advice. But the long-term impacts of economic stimulus as it pertains to asset values, so presumably stock values, but also, I'm assuming property values and that type of thing, cost of living and inflation. And then does the tech stock market have irrational exuberance? If there is an adjustment, how will that impact Pittsburgh's tech market? So certainly low interest rates are good for stock prices. And that's a big reason why we've seen the run up in stock prices since, the spring of 2020. And there are a number of factors. And so I do think that there are fundamental factors that have supported the improvement that we've seen in stock prices, including in tech prices. So low interest rates, a recovery in the economy, expectations for further stimulus that we might get under a Biden administration and a democratically controlled Senate. And so I do think that a lot of that has contributed to the run-up that we've seen in stock prices. Now, am I concerned that perhaps stock markets are underpricing risk right now? I do think that there is still a substantial amount of risk out there in the economy in terms of risks, for example, higher interest rates or a lack of stimulus or a resurgence in the pandemic with this mutation that we're seeing. Yes. And so I think that, I would be very surprised to see the big run up in stock prices that we've seen since the worst of the pandemic continue in 2021. So I think at best stock prices would be flat to up slightly higher. There might be a decline in stock prices in 2021. I would not be terribly surprised to see that. But I do think that, over the longer run that stocks do pay higher returns than other investments, if as an investor you can weather the ups and downs that you see in the stock market. In terms of other asset values, obviously one of the factors that's contributed to the improvement in the housing market, and we've seen a big increase in house prices lately, is very low mortgage rates. So with lower mortgage rates, that increases your ability to buy a home, and that with stronger demand has contributed to higher residential real estate prices. Commercial real estate prices, it's a little more mixed. Transaction volumes have really declined, so it's difficult to get a handle on the market. And I do think that we could see declines in commercial real estate prices just because of all those structural shifts that we're seeing in the commercial real estate market. In terms of inflation, as I mentioned, I think it's very difficult in the current environment for businesses to raise prices. Inflation has been very low for a decade. That's built into the economy. We've seen, even when we had a very strong job market in 2019 and the unemployment rate was below 4%, we saw very low inflation, and there is very little pass through of wages into broader inflation. So I'm not terribly worried about inflation. Risa, any thoughts on wage pressures, either now or in the future in terms of pass through to inflation and the potential for higher inflation there?
With respect to the wage, this really depends on how the pandemic will be handled. So, somebody asked about the rollout of the COVID vaccines. We found out this morning that there was actually no plan for how the vaccines were going to be rolled out. And so this incoming administration has to kind of step back a few months ago in order to start making progress. I certainly hope that there will be, like you said, our inflation rate has been pretty low. And we usually look at economic growth coming with higher inflation. Averaging 2% is what the Federal Reserve looks for. So, I'm hoping that we're going to be looking good in terms of the numbers, and hopefully the wage increases will follow as well. once we deal with the pandemic issues.
Yep. And I will say that, I mean, our forecast is for stronger growth, particularly as we get, after we get through the first quarter, but that all depends on the vaccine distribution. I think if that gets botched, if we're still dealing with the pandemic, 6 months from now, then I think that, we are just not going to see a very strong recovery. And the public health response, I mean, this is more so than the economic problems are caused by the public health problems. And if we don't get a handle on the public health problems, I think then, we're going to have, we're going to have some really, we're not going to have a very strong economic recovery. All right, let me go trying to get through. I think maybe have time for one more question here. Okay, so and I think this is for all of us. We know that the contraction disproportionately hurt the poor and disenfranchised, and that growth is essential to allow economic progress for more vulnerable workers. We've had below average growth over the past decade. What can we do to support regional growth to enable better outcomes for disadvantaged workers? So Kyle, if you want to start with that one.
In our last minute, that's a big question for 1 minute. I mean, I think, broadly, we've done a lot through the conference and the PRA in order to position, the region to really tell our story, raise our awareness as it relates to the outside the region in a way that, we haven't done in a long time. So I think that'll be a key kind of foundational piece to just increasing interest from outside the region to here. So I'll stop there. There's more I'd like to say, but we don't have much time, and I want to make sure you both are able to speak to it.
Riza?
So the issues with the economically disadvantaged, there's been longstanding issues with our access to education, income that's tied to family structure, poverty, food security, healthcare, etc. Now, what I'm very hopeful for is that this administration is looking at economists who have dealt with their research focus has been on dealing with all kinds of economic inequalities. And so I think for the first time, we have economic agendas that focus on those issues. So I'm hopeful that the recovery will come with addressing some of these big inequality questions that have come to the forefront.
Okay, great. Thank you very much. I appreciate that. And so, Amanda, am I kicking it back to you, or are you taking it on from here? So thank you very much, Riza. Thank you very much, Kyle. I thought that was a great discussion. I really appreciate the opportunity this morning.
Thank you.
Thank you all so much. That was great. Kyle, we appreciated your outlook as not being an economist, and appreciate your expertise this morning. I had answered one of the questions. This is being recorded, so it will be shared with the group after if you wanted to review anything that was shared. And then Brandon put a link in the chat if you would like to join us after for, excuse me, for some networking. You can find us on another Zoom link. And as Jamie mentioned, it is renewal season. So if you have any questions about renewing either your NAIOP or BOMA membership, reach out to Brandon or I respectively. And thank you all again for coming.